If you invested just $10 a day, would you want income or growth? It sounds like a small decision, almost boring, but over time that single choice shapes how your money behaves, how patient you have to be, and what you eventually get back. Most people make that choice without ever realizing they made it. In this video, I'm going to run a simple experiment using the same money, the same ETFs, and the same timeline, changing only one thing: whether the portfolio leans toward income or growth. We'll break down how each approach works, build one adjustable portfolio, and then turn the dial in both directions. And by the end, I'll show you how a growth-focused portfolio can add an extra $740,000 to your total value, while a dividend-focused portfolio can generate over $7,500 a month in income, all from the same $10 a day investment. The reason those two outcomes are possible comes down to one simple idea. Once your money is invested, there's really only two things it can do. It can stay inside and keep working, or it can start coming back to you as cash. Everything else people talk about is just a variation of those two behaviors. When money stays inside, it's being used to grow the business. It's invested in new products, expansion, efficiency. All of that gets funded internally. Nothing shows up in your account, but more value is being built behind the scenes over time. And that value usually shows up as a higher share price. The progress is real, but it's quiet. You don't feel it day to day. When money comes back to you, it's doing the opposite. Instead of being reused inside the business, a portion of it is sent out to investors regularly. That cash is tangible. You can spend it, save it, or reinvest it somewhere else. Feels reassuring because something is happening right now, not someday later. Here's the trade-off. Most people don't fully think through. Money can't be in two places at once. Every dollar that comes out is a dollar that isn't compounding inside anymore. That doesn't make one behavior right and the other wrong, but it does mean they lead to very different outcomes over long periods of time. This is why the decision feels so personal. Some people value seeing progress, others value building momentum, and most people actually want a bit of both, even if they don't realize it yet. Before we put labels on any of this, you're not choosing an ETF. You're choosing how your money moves while time multiplies. People usually don't start with the behavior. They start with the labels. Growth investing, dividend investing. Those words get thrown around a lot, but they're really just names for the two behaviors we've been talking about. When money mostly stays inside and compounds, that's what people call growth. Investing is not about chasing hype or taking wild risks. Music at its core, it's simply choosing to let your money remain fully at work. The goal is not to get paid today. The goal is to make the pile itself grow as large as possible over time. You don't see much along the way, which is why it can feel uncomfortable, but the expectation is that patience gets rewarded later through higher prices. Dividend investing puts the emphasis somewhere else. Instead of asking the money to stay inside forever, you're asking it to start paying you back along the way. Part of the return shows up as regular cash. That cash can be reinvested, used to cover expenses, or just held. The trade-off is that because some money is leaving the system, the pile usually grows more slowly. What matters here isn't the label, it's the job you're assigning to each dollar. Is it there to maximize future size, or is it there to create cash flow you can actually use, maybe today or maybe later down the years? This is where people often get stuck because the labels make it feel like you're choosing an identity. Like once you pick one, you're locked in. But that's not how this really works. These aren't opposing teams. They're just two ways of directing effort. And once you see them that way, the question stops being which one is better and starts becoming something far more practical. How should these two behaviors work together for you? Right now, this is where most explanations start to drift off track because they treat ETFs like strategies. They're not. An ETF is just a container. What matters isn't the label on the box, but what the box is designed to do with the money inside it. Some ETFs are built to keep most of the money working internally. The companies inside them reinvest profits instead of sending cash out. The goal is simple. Grow the value of what you own over time. Other ETFs are built to send a meaningful portion of that money back to you on a regular basis. The goal there isn't maximum growth. It's consistent cash flow. That's it. There's nothing mystical going on here. ETFs just lean in different directions based on what the underlying companies do with their profits. Some keep capital inside longer, others return it sooner. That difference alone tells you almost everything you need to know. Not whether an ETF is good or bad, but what kind of behavior it encourages. Does it prioritize compounding or does it prioritize income? This also explains why the same ETF can make sense in very different situations. The ETF itself doesn't change. What changes is how much weight it carries and what role it plays alongside the others you hold. So, instead of thinking in terms of growth, ETFs versus dividend ETFs as separate worlds, it's more useful to think in terms of tools. Each one nudges your money in a slightly different direction. Some push harder toward future size. Others pull value forward into the present. How you combine them determines what your portfolio actually does. If we look at ETFs that lean toward keeping money inside, a few patterns show up. Immediately, the dividends are small. Dividend growth exists, but it's not the focus. Most of the return shows up somewhere less obvious in the price itself. Take VGT first. This dividend yield sits around 4%, and dividend growth is modest at about 1.76%. That tells you right away this ETF isn't designed to pay you income. Almost everything it earns stays inside. The payoff for that shows up in price appreciation, which is averaged roughly 22.27%. This is money being recycled back into growth over and over again. SCHG behaves in a similar way but across a broader set of large companies. The dividend yield is even lower at about 0.36%, with dividend growth closer to 3.79%. Again, not much cash coming out. What you're getting instead is price growth, averaging about 18.14%. It's the same behavior, just spread across more of the markets instead of one sector. QQQ adds an interesting wrinkle. The yield is still low at about 0.45% music, so it clearly leans toward growth, but dividend growth is noticeably higher at roughly 9.73%. Music, even so, the real engine is still price appreciation, averaging around 19.52%. This is growth that occasionally throws off a little cash, but never at the expense of momentum. The pattern is consistent. Very little money comes out. Most of the return stays inside. And over time, that shows up as faster growth in the value of what you own, not regular income hitting your account. When ETFs lean towards sending money back to you, the pattern flips. Cash flow becomes the priority. Growth doesn't disappear, but it takes a back seat to consistency, music, and reliability. Start with SCHD. Dividend yield sits about 3.73%, and dividend growth has averaged about 10.61%. That combination tells you exactly what is built for regular income. That still grows over time. Price appreciation is there, averaging roughly 8.78%, but it's not trying to be the main driver. SPYD leans even harder into income. The yield is higher, around 4.44%, and dividend growth has been strong at roughly 19.44%. That income focus shows up in slower price appreciation, averaging about 4.68%. Music, more cash comes out, so less stays inside to compound. G pushes this idea to the extreme with a yield around 7.41%, 41%, and dividend growth near 7.88%. It's designed to generate income first and foremost. Price appreciation has averaged only about 79%, which isn't a flaw. It's a trade-off. Growth is intentionally sacrificed to maximize cash flow today. The difference compared to growth-leaning ETFs is immediate. Instead of waiting for progress to show up in price, income arrives on a regular schedule. It's visible. It's tangible. This is the defining feature of dividend-leaning ETFs. In a couple of minutes, I'll show you how this same portfolio can be adjusted toward growth or toward income. And by the end, you'll see how a growth-focused version adds an extra $740,000 in value, while a dividend-focused version generates over $7,500 a month in income, all from the same $10 a day investment. Before that, let's look at how one portfolio can do both at the same time. By this point, the picture should feel clearer. Growth and dividends aren't rival strategies fighting for dominance. There are two behaviors that can exist inside the same system. Once you strip away the labels, the conflict disappears. One behavior keeps money inside and compounds faster. The other pulls money out and turns it into cash flow. Neither one cancels the other out. They simply pull in different directions. This is where a lot of people overcomplicate things. Music, they think choosing growth means abandoning income, or choosing income means giving up growth forever. But that's not how portfolios actually work. In practice, there's no rule saying money has to do only one thing. Some of it can stay inside and push for long-term growth. Some of it can come out and provide cash along the way. The real decision isn't picking a side. Deciding how much emphasis each behavior gets at the same time. Think of it like a dial, not a switch. You're not turning growth off to turn income on. You're adjusting the balance between the two. Turn the dial toward growth and most of the money stays inside. Turn it toward income and more of that money starts flowing back to you. Now the question is, how should this dial be set up for you right now, given what you actually want your money to do? With that dial in mind, this is where everything finally comes together. Instead of building two separate portfolios, it makes more sense to think in terms of one adjustable portfolio. The ETFs don't change. What changes is how much weight each behavior gets inside the same structure. This approach removes a lot of unnecessary pressure. You're not committing to an identity or locking yourself into a single path forever. You're deciding how you want your money to behave right now, with the understanding that the balance can always shift later. So imagine one portfolio built from the same growth-leaning ETFs and the same dividend-leaning ETFs we just talked about. No new tools, no extra complexity, just different emphasis. When the dial leans toward growth, more weight goes to the ETFs that keep money inside and push for price appreciation. Dividend ETFs are still there, but they play a supporting role. When the dial leans toward income, the balance shifts. Dividend ETFs take the lead and growth ETFs move into the background to keep long-term momentum alive. This framework is what keeps things simple. You're not starting over. You're not rebuilding from scratch. You're just adjusting how much of your portfolio is focused on future size versus present cash flow. And with that structure in place, we can finally look at what those two dial positions actually look like in practice. Start by turning the dial toward growth. This is what the same portfolio looks like when future size is the priority. In this position, 75% of the portfolio is allocated to growth ETFs and 25% to dividend ETFs. On the growth side, VGT, SCHG, and QQQ are each weighted at 25% of the portfolio, making up the majority of the structure. These are the ETFs that dominate how the portfolio behaves. The remaining 25% is spread across SCHD, SPYD, and JPI, each at about 8.3%. In this setup, they aren't meant to drive income. They're there to add balance and a small amount of cash flow without slowing the growth engine too much. When you blend everything together, the portfolio reflects that emphasis. Clearly, the blended dividend yield comes out to about 1.6%, 6%, which tells you very little cash is being pulled out along the way. At the same time, average share price appreciation across the portfolio lands around 16.17%, meaning most of the return is happening through rising prices, not income. That's the trade-off by design. This setup isn't built to feel rewarding month to month. It's built to let as much money as possible stay inside and compound over time. This is what a growth tilted position looks like in practice. Now turn the dial the other way. This is the exact same portfolio built from the same ETFs but tuned for income instead of maximum growth. In this position, 75% of the portfolio is allocated to dividend-leaning ETFs. SHD, SPYD, and JPI are each weighted at 25% of the portfolio, and together they drive how the portfolio behaves. Music, the remaining 25% is allocated to growth ETFs with VGT at 8.34%, music, and SCHG and QQQ at about 8.33%, music, each. Their role here isn't to lead, it's to keep long-term growth alive in the background. When everything is blended together, the income focus is clear. The portfolio produces a dividend yield of about 4%. And just as important, music, that income isn't static. Average dividend growth across the portfolio comes in around 10.76%, meaning the cash flow is designed to grow over time, not stay flat. That shift shows up on the growth side as, well, average share price appreciation drops to about 8.56%. Growth hasn't disappeared, but it's slower by design. This setup trades speed for reliability. Instead of waiting for progress to show up in price, value shows up as growing income along the way. This is what the income tilted position looks like in practice. Same portfolio, same tools, just a dial turned toward long-term value into usable cash along the way. Now we can finally put real numbers behind everything we've been talking about. Same ETFs, same structure, same daily effort. The only thing that changes is how the dial is set. In both cases, the setup is identical. $10 invested every day. No starting lump sum dividends. Fully reinvested 30 years. Start with the dial turned toward growth. With a daily contribution of $10, by the end of year one, you would have invested $3,650. From that same starting point, the long-term picture begins to separate. After 10 years, the portfolio is projected at about $82.15. By 20 years, it's valued at roughly $460,610. And after 30 years, the portfolio ends up around $2,169.3. what's driving that results becomes clear when you break it down. Over the full 30-year period, the total value added is about $259.53. Of that, roughly $235.545 comes from capital appreciation, while only $23,958 comes from dividends being reinvested. Almost all of the growth comes from money staying inside and compounding. Income does exist at that point, but is modest by design. After 30 years, the portfolio is projected to generate about $1,821 per year in dividends, which works out to roughly $152 per month. Music, this setup was never meant to pay much along the way. It was built to maximize long-term value. Now, look at the same daily contribution with the dial turned toward income. Again, by the end of year one, you would have invested the same $3,650. After 10 years, the income-focused portfolio is projected at about $67,630. At 20 years, it's valued at roughly $323.65. And after 30 years, it ends up around $1,426,747. The breakdown tells a very different story. Over the 30-year period, the total value added comes to about $1,317,247. Of that, only $739.47 comes from capital appreciation, while a much larger $577,840 comes from dividends being reinvested. Along the way, that income focus becomes unmistakable. By year 30. The portfolio is projected to produce about $92,035 per year in dividends, which comes out to roughly $7,670 per month. A significant portion of the portfolio's final value comes from cash being paid out and reinvested over time, not from rising prices alone. Same daily contribution, same time horizon, two very different outcomes. After 30 years, the difference between the two approaches is clear. The growth-tilted portfolio ends up valued at about $2.17 million. The income-tilted portfolio ends up around $1.43 million. That's a gap of roughly $740,000 in total portfolio value created by the same daily contribution over the same time period. But the income side tells an equally important story. Year 30, the growth-tilted portfolio produces about $1,821 per year in dividends, or roughly $152 per month, while the income-tilted portfolio, by contrast, produces about $92.35 per year, or roughly $7,670 per month. That's a difference of more than $90,000 per year in income. So who wins? Well, if the goal is maximum net worth, growth wins. Letting more money stay inside and compound for decades creates a much larger final pile. If the goal is cash flow you can actually live on, then income wins. The income-tilted portfolio sacrifices long-term size in exchange for financial flexibility much sooner. This isn't a case of one strategy being smarter than the other. It's a case of priorities. One approach maximizes future value. The other converts value into usable cash. Want a simple, beginner-friendly strategy using only 2 index funds that can grow a $9 daily investment into over $1 million and pay more than $7,000 a month in dividends?